This video is brought to you by Brazil Resources, trading on the TSX Venture Exchange under the symbol BRI, and on the OTCQX International Market under BRIZF. Brazil Resources just announced an agreement to acquire 100% of the Cachoeira project from Luna Gold Corp. The deal terms imply BRI is paying $18 an ounce for gold in an emerging gold district in northern Brazil, located near BRI's other 3 gold projects. The company is 35% institutionally owned, with 16% of outstanding shares held by the KCR fund, controlled by Doug Casey, Rick Rule, and Marin Katusa. The geological team has earlier discovered more than 10 million ounces of gold directly in Brazil, and is led by successful mining CEO Amir Adnani. To learn more about Brazil Resources, visit BrazilResources.com or call 855-630-1001. Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with special guest Jeff Nielson of BullionBullsCanada.com. For those looking for information on precious metals, I highly suggest you check out his website today and certainly listen to this interview. Jeff, thanks for being on with us today.
Thanks for the introduction, and it's nice to be here.
Jeff, I'd like to start off with the precious metals with this fiscal cliff thing. You know, nobody really talked about the fiscal cliff before the election. Now all we hear about is this fiscal cliff. Do you think that the United States going over this fiscal cliff where taxes are going to be increased and these automatic fake cuts are going to happen, you know, do you think people are going to perceive this as an economic event or a monetary event? You know, what I'm trying to get at is, should we see the precious metals rally off of this, or do you think we're going to see kind of like a 2008 thing where silver goes down because people are worried about a severe recession for the industrial purposes?
Well, for me, this is such a complicated question because of a couple of more or less competing dynamics. You know, on the one hand, I just finished writing a commentary, which I titled The Great Price Disconnect. And, you know, I point out that as our paper currencies are plummeting towards zero, you know, and the definition of hyperinflation, that there's a real significance to this that nobody's really considering. You know, specifically, you know, talking about it in hypothetical terms, as our paper currencies plummet towards zero in this era of competitive devaluation, the actual difference in value between, you know, for example, a $10 bill and a $1,000 bill steadily shrinks. So, significance of that is that in this world of manipulated markets and manipulated prices, the actual difference between pricing something at $10 and pricing it at $1,000 is going steadily to zero. In other words, you know, as the currencies become more worthless and thus more artificial, manipulation becomes actually easier and rather than less difficult. We're getting closer and closer to the point of no return, where we have the actual crash, hyperinflationary crash. But until that event occurs, you know, the opportunity and the ability to distort markets actually increases. Now, the other side of this is that for me, this so-called fiscal cliff is nothing but a figment of propaganda. I mean, you know, if people have been following my writing, they see that the U.S. economy has already been taking a major nosedive, and the next crash has already begun. You know, retail sales have collapsed. Unemployment continues to worsen rather than improve, despite the absurd reports that come out. And so basically what I look at the fiscal cliff as is a media creation to explain a crash they can no longer prevent and cover up. So there is going to be a big economic crash, but, you know, rather than this being some sort of cliff, you know, sudden phenomenon, it's just merely the culmination of a period of decline that, you know, is, for me, is fairly well telegraphed.
Now, Jeff, with that type of demand destruction that a crash would cause, how will we see hyperinflation?
Well, you see, but this is the whole thing here, is that people have, and this is where I get frustrated with the so-called deflationists, is that there's a problem with perspective here. We're talking, you know, hyperinflation, we're talking about currencies going towards zero. You know, this is not some, you know, partial move. You know, this is an absolute dramatic collapse in value of a particular asset class. Compare that to, you know, so-called demand destruction. Demand can never go to zero. You know, if we see demand decline by 10%, you know, that's a major collapse in demand. So if you have the two dynamics of paper becoming literally worthless and demand plummeting by 10%, maybe 20, 30% in some horrendous depressionary scenario. Obviously the hyperinflation must dominate. And this is also, why I follow John Williams of Shadow Stats and his call for hyperinflationary depression. I see exactly the same thing that he describes. The prices for hard assets exploding upward in the hyperinflationary surge, and the prices for the bankers' fraudulent paper assets plummeting to zero in the mother of all paper depression.
Now let's talk about that. So if someone does want to prepare for hyperinflation, obviously there's some obvious things they can do, like having some extra food, buying some things in advance that you may need. What about when somebody says, you know what, I want to try to make the most of the situation. I want to try to profit off of this. Where should they start? And then eventually when they get, if they purchase, I'm talking about like regular preparedness items, where should they start when they're looking to say, you know what, I want to try to increase my wealth during this crisis?
Well, for me, what is so important here is that people not lose sight of the fact that we're playing defense. And, so I get uncomfortable when I hear people talking about, trying to profit from what lies ahead, when, ultimately what our mindset must be, first and foremost, is how are we going to survive what lies ahead? And of course, you're talking about that in part yourself with preparedness and stocking up on various things. So, obviously that's part of your own equation here. But for me, that's got to always remain a central focus and guide us in our investing. Because if we're playing defense, that implies that we can't afford to be aggressive. And, of course, when we talk about precious metals, there's the opportunity for profit because we know that they're artificially undervalued. But, ultimately the process that's taking place here is not an increase in value of gold and silver, but it's just the paper going to zero. Ultimately, we're still going to be sitting with the same ounces of gold and silver at the end of the day. It's just in nominal prices. They're going to approach infinity. So, for me, I always look at it as wealth preservation rather than profit opportunities. And from my thinking, if you keep that disciplined, prudent focus, that's when you're going to end up having the best opportunities to profit.
Part of that defense strategy, should that be getting rid of real estate, getting rid of stocks, paying off debt?
I would certainly recommend getting out of most forms of paper, and I'm extremely leery about the real estate market because of the near zero interest rate hell we're living in. Because the problem with having near zero interest rates in a world of high inflation and raving savers is that any real estate market is always going to be in a cycle of either a building bubble or a bursting bubble. Because the governments are literally forcing people to pump their money into something, and real estate is always the first place that money goes. So the bubbles go up, the bubbles go down, and it's just a real dangerous place to try to anchor your wealth, in my mind. And similarly, for many of these paper assets, if we are headed towards the mother of all paper depressions, you want to be out of most forms of paper. And, personally myself, the only forms of paper I feel confident holding are the equities of gold and silver miners.
Now, a lot of people have been worried about systemic risk. So when you put your confidence on the gold and silver miners, in this hyperinflationary event and crisis that you foresee, do you see the miners being able to rally, or will the Dow Jones being rally as well? Will everything be going up?
Well, of course, as I was just explaining, we have this crazy price disconnect where over any sort of short term or even a medium term, the prices are almost meaningless. So, I don't have a crystal ball, so I'm not going to claim to say that I know what's going to happen over the short or the medium term. However, you step back and you look at the big picture, and it is safe to say what's going to happen over the long term. And, the one advantage that equities have over other forms of paper, most notably bonds, is that there's no implied collapse to zero in any major systemic event. With bonds, if there's debt default, those bonds go to zero, plain and simple. But, with the equity, with an interest in a corporation, as long as that corporation remains in business, even if markets themselves shut down for extended periods, you retain that equity interest and equity ownership. And when the markets resume and when normalcy resumes to the economy, there'll be some recovery of normalcy in those prices as well. So, this is why a lot of people have gravitated toward equities in potential areas of hyperinflation because they know that the equities should not go to zero and could, of course, inflate somewhere close to, the rate of hyperinflation.
A lot of people were hoping the junior miners would have done really well over the last few years, as we've seen the gold price literally double since Lehman Brothers. Although the juniors haven't fared so well. In fact, this year, I believe the TSX is down around 50%. What are your thoughts on the current, the specifically for the junior mining companies?
The thing is, when we talk about manipulation, if anything, the miners are subjected to even more rabid attacks from the banking cabal. And the reason for this is, those who understand the fundamentals for the miners realize that precious metals miners should always leverage the gains in the price of the metal, which, of course, is why a lot of people gravitate towards them as investments. What this means to the market is that when the miners are rallying, this telegraphs a bullish aura for the sector and attracts more investor dollars. So, of course, ensuring that the miners are never, quote-unquote, rallying is one of the primary focuses of the banking cabal. And that's why we see people investing in these companies really being tortured unless they're prepared to stick it out for the long term. And so look, using myself as an example, and of course not portraying myself as any kind of expert investor, before the crash of '08, I was stumbling along with just a sideways performance in my portfolio for a couple of years. Then the crash of '08 occurred, and my portfolio declined a further 80%, from that level. Mm-hmm. But, I waited it out. The bottom occurred, and then, of course, the junior miners were so insanely oversold that they bounced back, and my entire portfolio increased by more than 1,000%. So, there's been these crazy, dramatic twists and turns, but as the dust settles today, not only am I way ahead of where I was at the beginning of 2009 after the crash, I'm considerably ahead of where I was prior to the crash of '08, even with prices today for the miners being, once again, very depressed. And so, for me, I look at the performance of these miners over the longer term and say they haven't done very bad at all because, my own portfolio is living proof of that.
Jeff, when people talk about the banking cartel, the gold cartel, and manipulation, what's something simple that someone could explain to someone who's buying gold and silver, and they talk about manipulation, but they're not an expert, they're not you, they're not Bill Murphy, they're not Andy Hoffman. What's something they can point out to their neighbor or to their family member that, kind of gives somebody else an aha moment where they, okay, yeah, I do understand that there is manipulation?
Well, we can just look at two things together in comparison. On the one hand, we see the ratio between the price of gold and silver at, a relative historical extreme of roughly 50 to 1 right now, when over, close to 5,000 years, that ratio has averaged 15 to 1. And yet this extreme ratio in terms of gold to silver is occurring at the same time that we know that, going from a period of 15 years from 1990 to 2005, silver inventories, global silver inventories plummeted by 90%. So, with that rapid collapse in silver inventories, the actual ratio of physical gold in the world versus physical silver hasn't been this extreme for 500 years. And yet we see the prices in the opposite direction. So that's not simply inconsistent. That's a total perversion of what supply-demand fundamentals should be dictating. And, for me, that's just one of the, aha moments you refer to.
Mm-hmm. Jeff, thank you so much for your time. Jeff of BullionBullsCanada.com. We have to have you on a lot more. It was very good talking to you, and I'd like to talk to you more about the economy maybe in a few weeks.
Be happy to be back.
Thanks so much for your time, Jeff. You have a great day.
Thanks, you too. Goodbye.